Hey there, everyone. We're going to talk in this video about the 4 pillars that I think it's going to take to really have this market catalyze and push back up. And if any of those pillars should give all the way, I think that that's something that is really going to be rattlesome to the market. It's going to destabilize it in a much bigger way than what we've seen right now. So I want to make this very clear for everybody. I talked about this in terms of the Russell 2000 stocks, said it also applies to the NASDAQ 100, S&P 500, Dow Jones. It also is the bond market. It's what we see for the crypto market as well. And what we're trying to determine with it is what sort of risk environment are we in and what is it going to take for the market to rally. So you can even tell, look at the crypto market if you want to talk about risk environment and see what happened with Bitcoin lately. And that is part of that trouble that we have and why we kind of stagnated and traded sideways and tumbled down a bit is we're really infringing on that idea that it's risk on, let's go. It seems to be more at this point in time like we should be cautious right now while we're trying to figure things out. The market's trying to make up its mind. We have further evidence that we touched the 200-day with the S&P 500 and with the NASDAQ 100 as tracked by SPY and QQQ. IWM, which I said would be more sensitive to it, has sold down below the 200-day and now risks a death cross with the 50-day crossing down over it. So we have a lot of evidence to suggest right now that the market's pretty bothered by what it's seeing and it's trying to make sense of where it's going to go next. And we have, well, I'll talk about those 4 pillars now, where GDP is one of the first major things. That's the first pillar that we have. We need strong GDP numbers of 2% or better in order to help prop up this market. And I'll get into the charts on that and what exactly we've seen recently that really destabilized that pillar. But then we also have easy monetary policy to talk about from the Fed. What's the federal funds rate looking at? Are we going to get money thrown our way? Or is it going to make it easier to borrow, cheaper to borrow? That's really going to impact the GDP number as well. And that also affects what we see in the market. Cheaper to borrow money means easier to invest, get easier to have a return to outstrip the interest payments that you would take on something like that with the market. So, moving on from there, the next pillar that we have to look at is the unemployment or the labor market as the two of those. Well, the labor market with unemployment, non-farm payrolls, we get that report happening on Friday. And so altogether, those pillars that we have of the GDP, easy monetary policy, inflation, I think I forgot to mention that one, but inflation, man, that's a question mark right now. Is there cracks in the pillar? It certainly hasn't crumbled, but are there cracks in it? Or is it just sort of surface stuff? We don't have to be worried about it. It's not structural. That's what we're trying to find out. And then, of course, the labor market. So those are the 4 pillars. Let's get right into the evidence on this one. So the very first thing is the Atlanta Fed GDP now. Now, of course, this is old news. We've seen the market fall, but that's the evidence that we're looking for, that this really is one of those pillars that allows the market to either rally or tumble down. Blue chip consensus just fine for a while. The dates from December up until end of February, fine. Then all of a sudden, this negative 1.5 pops out of the blue, out of nowhere. And then what we had for the most recent update, negative 2.8 on March the 3rd, 2 days later, the market's like, okay, well, this is just looking forward for Q1. Mind you, Q1 GDP doesn't come out. The advanced estimate for that is on April the 30th. If I scroll up here, you can see on Trading Economics, April the 30th, and daylight savings time adjusted. This is 8:30 a.m. Eastern time. By the time we get there, we just haven't moved the clocks forward yet. So the 7:30 will change to an 8:30. Trust me that it is 8:30 Eastern time that we see that GDP advanced estimate. We're looking for that growth rate. And right now, before we were at 2.3%, this is saying 0.9. So even that's a bit of a slowdown. This is why you don't see the market rallying to new highs, because that's one of the questions that we have. Now, with that said, that should lead to more easy monetary policy because we don't want to see GDP tank. And so when we look at that in terms of what's the federal funds rate going to do, I have December brought up. So this is talking about more easy monetary policy, hopefully from the Fed, reducing that federal funds rate, making it cheaper to borrow that cash, bringing down other interest rates that consumers and businesses would pay. Well, when we look at that right now, there has been some impact. We were looking at 3.75 to 4% for a federal funds rate going back to a month ago, a week ago, and then when we moved to a day ago, that actually shifted to another 25 basis point cut. Thanks to GDP kind of pushing that down a little bit, but why isn't it dropping down more? And even today, as I look at this number, 31.5%, hasn't dropped down more, because if we go over it and look at what we have for the core inflation rate as per the CPI, once again, trading economics bring us this information, you can see we went from moving downward and inflation dropping and the market rallied during that time to all of a sudden going sideways on us, being that higher for longer. And even then the market was like, fine, we're cool with it, whatever. But then we got this 3.3 pop out, 3.3, 3.3, 3.3, 3.2, back to 3.3. The market's going to hate it if that inflation moves up. To me, the higher for longer is surface level cracking, not structural cracking for that pillar of inflation. So for GDP, cracks, not necessarily structural, because we don't know that we're getting negative GDP estimate are coming out because we don't have the advanced estimate. Right now, we just have the Atlanta Fed, which, mind you, the next release is on March the 6th. And then 11 days after that, we get more and continued updates up till March the 28th is the last one. And by that point in time, we should have a much better idea of where GDP is going to land for that advanced estimate on April the 30th. That's why it's not crumbled yet, because we don't have that hard information yet. That report is not out yet. 2 consecutive quarters of GDP decline is where we're going to find that recession kind of stuff come in. So that puts pressure on April and July. And so that can be a really wacky time for us if that number doesn't improve as those reports come out. So the sooner that returns to positive, as those reports unfold throughout March, the better. So for inflation, this is the reason we don't see that easier monetary policy coming in. The Fed's still stuck between a rock and a hard place. They want to make easier monetary policy so that GDP can remain afloat, but they also can't lose their grip on inflation as well. And now, mind you, something's going to give there, because if we have that GDP decline, then most likely something gave with the consumer, which cuts the pricing power of companies. That means inflation is going to come down, but we don't want to go deflationary because that points to recessionary. Market falls anyway. So we just got to be careful with that nuance. We want lower inflation, but we don't want it at the expense of recession, at the expense of a recession, I should say. So it doesn't sound like expensive recession. So if we go over to the PPI numbers that we have for that, what we see there for PPI coming out after that is that we start to see that drop coming in for this. So I'm sorry, PCE numbers. My apologies. So for those PCE numbers, we actually do see a little bit of a decline after a little bit of a scary spike there going into December, and then we start to drop down. We just need to see that continue to head downward. We want to see subdued inflation. We don't want to see deflation come our way. Disinflation is good. Deflation coming our way, bad thing, because once again, that points to recession. Once you enter that cycle, I share that vicious cycle with you towards the end of this video. We just need to watch for it. Now, so out of the 3 pillars that we've gotten so far, GDP, not looking great. As far as monetary policy goes, using monetary policy, well, between GDP, for what we have there, we definitely want to drop it down. The federal funds rate, we want that to come down to help out GDP, but we don't want it at the expense of high inflation. So the Fed's kind of stuck right now. We'll see what happens as those inflation reports come out. CPI is going to be the first one that hits us, and at the end of the month, we'll get the next PCE read. We want to make sure that doesn't get away from us. Now, last, the labor market, non-farm payrolls. What we see for non-farm payrolls is that we see this downward inflection, this concave down, if you will, where we have growth, but slowing growth for those non-farm payrolls. And if I reset the zoom, you can actually see the rolling over periods that we get. Here's the Great Recession. When you start to roll, it's hard to stay out of that rolling down. It's like a slippery slope. This is going to rattle the markets too. It's going to anticipate it ahead of time. And then when it really starts this downward descent, you usually have other indicators out there that would confirm this besides just rolling over. For instance, you see a little bit of a change here. Doesn't necessarily mean that the market went with it. And if you look at all the other times that we started to roll over those gray areas, that drop in non-farm payrolls really went along with those recessionary times. So we just want to watch for that. Unemployment rate, what are we looking at for that? Let me reset the zoom. Well, this is really, with the unemployment rate, this is where really things can take off, because once that employment rate starts going, man, it really rips. So yeah, you can see that happening, that up, not so bad, but once you start to precede those previous peaks, that it starts to get out of hand, it keeps going out of hand because it kind of can put those ideas in people's minds along with recession, and then people stop spending as much, so businesses aren't selling as much, so they stop producing as much, so they don't need people. I'll get into that cycle in just a moment. Where do we find ourselves right now? Well, just we have a little bit of stabilization. So we started that upward climb into August, into September, and then it just sort of stabilized on us. Cool. Good. Market rallied. Game on, right? So what we don't want to see is in this most recent part here, to get the pandemic out of there, is that we don't want to see us break that 4.2. If we hit 4.3, the market's not going to like it. It's going to be like, oh gosh, new high, new peak. Could this be it? Is this the next thing coming? So that last pillar of that stable employment, that tight labor market that we're looking for to make the market rally, right now it's okay. Maybe surface level cracks, but honestly, 4% is a really good number. If we look at things historically, go over the past 10 years, you can see that we're still in pretty low territory like we were prior to the pandemic. We're still down below that 5%. And if I go out max to look at that, we're still down in the lower part of this between the 2.5 and 5%. It's about 5% that things are really hairy in the economy. So we want to be watchful for that. We're still in good position. We don't want to see the increase, because once that increase starts happening, the market gets rattled, and then potentially you get even sharper increases from there. Last thing I want to leave you with, if I go to this, what is a recession? This cycle, this vicious cycle that you see, is that if people start to think that it's time to really start holding on to our money, that maybe things aren't looking so good and we should really start conserving, and that can bring in like M2 money supply, for example, that people are holding on to more of their cash instead of spending their cash, and that gets even to the velocity of money. Well, sales fall, which means that businesses don't need to produce as much, so then they cut people, employment falls. And so because employment falls, incomes are falling. Or maybe because businesses lose pricing power and they're trying to maintain their margins, or they're trying to show growth, maybe they don't give those bonuses. Maybe it starts with income and then goes to sales and then goes to production and then goes to employment, and then we get stuck in that loop. So am I saying that we're going into some sort of deep, dark recession or anything like that? No, but I do want to talk about what could potentially lead into it. These 4 pillars are what it takes for the market to rally, the strength that we're looking for in order to push us to new highs. And when we don't get there, why not? These 4 pillars, watch for the destabilization, because those are the things that can rattle those markets directly. So even if it is geopolitical news that rattles the markets, it's because one of those pillars gets shook, at least in my opinion. And I think it's a pretty darn good opinion if I do say so myself. If you guys want to talk to me more, see more of what I do with the markets, technical analysis, trades, you name it. I'm a panel expert over at the Discord that I'm in partnership with StockMo, and you can join our Discord by using the link down in the description. Find that link, click on it, sign on up. Thousands of members, a vibrant community, and there are tons of resources over there, tons of products and services that you can absolutely just live inside that Discord and learn so much and get so much information, not only from the panel experts, from StockMo himself, but also from the community that's out there. The people are excited. They're talking about it. There's the bread bots over there for setting up and looking for trade ideas. You also have AI tools. You have advanced charting, and there's talk about stocks, crypto, really any facet of finance that you could think of. It's in that community. I'm so excited to be part of it. Find that link in the description. Sign on up. And guys, if you're interested in learning more about technical analysis, what to trade using the bread recipe trading strategy, or a top-notch, just wonderful options course at StockMo Academy, you can find that link in the description as well. Click up and sign up using the code word doctor. It's going to save you a ton of cash when you sign up. But even so, even if it wasn't for that coupon code of doctor, you'd still be getting an incredible value, because you get lifetime access and just like small, easy to digest pieces of super critical and crucial information that make you more informed about technical analysis trading, and then also how to use options to really fill out those portfolios. And so guys, check them out. Links in the description. Code word doctor. Hit me up in the comments of this video as well. I'd love to hear from you. Subscribe to see more of my information as it comes out. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning. And we'll see you in the next video.